Okay, everyone. My name is John Netto. This is the third webinar in this series. Our host Alex is a little he's rocking away here, and we appreciate him for setting all this up. And I can't say enough how honored I am to be here. It's great to be here with all of you. This is 36 minutes with me. I'm very blessed. I was featured in the book Market Wizards with Jack Schwager a couple of years ago, and I'm just looking to share information with this wonderful trading community and at the same time raise awareness for some really important causes out there. It's 11 a.m. on the East Coast. It is 3 p.m. or 4 p.m. in various parts of Europe, even 5 p.m. depending where you're at. It is 8 a.m. here in Las Vegas. I am wearing, for those of you in the United States familiar with college football, I'm a University of Washington alum, and the Huskies are going to be playing tonight for the national championship against Michigan. So you know what I'll be doing later on. And today I'm wearing my Washington gear to support my alma mater. So that'll be a lot of fun. Okay, so let's get down with this webinar. So this is the third webinar. The first webinar we talked about building a business plan. The second webinar we talked about a trading journal. And today we're going to go into the Netto number. Again, for those of you, if this is your first time here today, we appreciate you attending. That's wonderful. Just a quick thing about me. I've been in the capital markets for about 25 years. I wrote a book called The Global Macro Edge. I'm currently a law school student here in Las Vegas at University of Nevada, Las Vegas, UNLV, in my second year. I have a language background. I speak Japanese, Chinese, Portuguese, and Spanish, having lived around the world. Part of when I was stationed in the Marines, so I've had an opportunity and been blessed with a lot of international experience and a lot of different disciplinary experience as well between finance and the law. So it's really great to be here with you guys in the capital markets today. Okay, so this third webinar, I want to just briefly kind of talk about what the presentation will encapsulate. So one, I'm going to spend a fair amount of this 36 minutes on the Netto number itself. And then I'm going to go into a little bit of what we have in the market. So that way we have, sort of some evergreen content in terms of the Netto number, which is consistent thematically with these webinars that we're doing. But I also want to touch on kind of the next 2 weeks of what's setting up in the markets to give you guys a sense of we're already 1 week into the trading year and at least thematically what I see going on and where there's some opportunities maybe lying in the markets just generally and give you some context on that and then open the floor up for some Q&A. So let's first get down to the Netto number component of this and rock and roll. The Netto number. This was a huge part of my book, The Global Macro Edge, that came out in 2016. And really what the Netto number does is it's a new way to look at performance and implementing it as a tool to measure how well you are risking a little to make a lot. And that's something that I'll get into in a little bit here and throughout this presentation. And let's talk a little bit more about that. So the Global Macro Edge, which came out in 2016, spent about 5.5 years of my life writing this book. Was very blessed to have a lot of practitioners participate in it. And we wanted to streamline it and not make it kind of this wonky finance book. So we tied it around busting what we believe were the 6 biggest myths on Wall Street. Okay, and the first one of those, which is what today's presentation is going to address, is that more risk equals more return. Some of the other myths is you can read, money will always find its most efficient home. That's not true. Emotions are your biggest enemy. We actually think they can be a huge ally. Diversification, there's some myths about that. There's more opportunity in the past, and then compensation should be based on returns. And so today's Netto number plays actually to both the first and the 6th myth of the Global Macro Edge, because as we'll talk about, or at least we won't get into today's webinar, but at least you can, through implication, know that the Netto number not only lets you see how well you're risking a little to make a lot, but then you can potentially around that set up a compensation structure around that. So if you're a strategy and you're looking to allocate to someone, if someone's doing a great job of risking a little to make a lot, you want to pay them more potentially, or if you're the trader, you want to receive more. On the other end, if someone's just risking a lot to make a little, you don't want to pay them anywhere near as much because both of those are a reflection of someone's investment and trading skill. So that's sort of where that plays to. So let's talk about myth number 1. And like I just mentioned, and that is more risk equals more return. Just conceptually, what's wrong with that? Well, the first, it's intellectually lazy, okay? Because if you simply say that the only way I can generate more risk or more return is to take on more risk, it assumes that there's no other edge in the market, right? That's a necessary assumption of that statement if that's what you truly believe, okay? And then you're basically saying the market's completely efficient and there's really not much you can do when it comes to picking up edge. I mean, and that kind of plays to a broader exogenous risk versus endogenous risk, meaning what sort of outside expenses you have versus what kind of inside market, strategy tweaks you can make. But really what this comes down to, and this is what I talk about extensively in the Global Macro Edge, or GME, the acronym for that, is that it's actually smarter risk that equals more return. So you can, with the right edge, risk the same amount of money, but actually increase your return profile or increase your potential returns, by 50%, 70%, 100%, 150%. So instead of risking one to make one, you can risk one to make 1.5, with the same risk around. Or you can invest in a strategy or you can blend various strategies to synthetically replicate or make a better risk return profile. But the key is you want to control that variable, the input of that, i.e. what you're risking, and then correspondingly, make what you get on the other end work out. So a lot of people, or a number of people, unfortunately, more risk just simply equals more risk, and we want to change that. All right. So what's the solution? I'm showing you this early because it's a little wonky, but at least conceptually you can see, all right, what the Netto number formula entails. And then I'm going to walk through these inputs because I don't want to be so abstract that I literally just show you, I'll walk you through these things, but I want to, at least in the beginning and then at the end of this presentation, we'll come back to this formula, all right? And just at a very simple level, there are 3 dimensions of risk out there. The first is, what did I make? So if someone says to you, all right, what did you make last year in the market? Well, I made 10%. Or what did Google make? It made 18%. Or what did Netflix make? It made 3% on the day. So that definitely gives you some context, all right? And we appreciate that. And so that's the rub there. But there's a second dimension, and it's something that a lot of institutions use, and that is things like the Sharpe ratio, the Sortino ratio, the Kalmar ratio. And what that entails is measuring risk, and this is the second dimension, and that is measuring risk relative to the realized volatility of a portfolio. And that's also important. That second dimension provides a lot more insight because we know that there are stocks that have a lot more volatility than the underlying market. And so if one stock with a lot of volatility, made 2% on the day, that's a lot different than another stock that made 2% with relatively little volatility. And so when you see, a utility company make 2%, that's a lot different than Netflix making 2% on the day, all things being equal. And so that second dimension at least gives you some context around the return, i.e. what's the normal volatility of that stock. And then we come into the third component, third dimension, which is the Netto number, which I think trumps them all, because what we don't know in that previous scenario is what was the ex ante risk in that metric, meaning what was the risk beforehand. So let's run through an example of that. If I give, and we touched on this a little bit in the first webinar, so please go to the Trading Pit and watch this first webinar again if you haven't seen it. And that is, if I have 2 managers, okay, and I give each of them $1 million, all right, and I say to our host, our beloved host today, Alex, I'm going to give you $1 million, and I'm going to throw a $200,000 risk budget, meaning if that account falls from $1 million down to 800,000, okay, so if your account falls down to 800,000, I'm going to pull the plug. And then manager 2, I give him $1 million or her $1 million, and I tell her, okay, you don't have a risk budget. You can lose the whole thing. Well, that ex ante, or that before the fact, that predetermined risk budget, that predetermined unit of risk, I use those terms interchangeably, matters, because it lets you know how well that strategy or how well that manager manages that. And so then the question becomes, well, how do I factor that ex ante risk into the overall equation? That's what this Netto number does here. And this is, spoken about extensively in the Global Macro Edge, the mathematical process, and then really the process of actually coming to developing strategies, etc. So in this example here, we have profits of $100,000, and we have this risk factor, okay, and of $1 million. And so you take the profits and you divide it by the risk factor. And I'll get into how you determine that risk factor. But basically, it's taking the size of the risk budget and the volatility, and you average those out, and then that becomes the denominator. That becomes the denominator there. That's that $750,000, and that numerator sits on top. That's a $100,000 metric. But again, let's walk through the inputs here. I just wanted to introduce that from a conceptual perspective before we get on here. Boom. Okay. So, like I said, measuring your performance and assessing your business plan. All right. This is something that going back to the very first webinar, you are here as a business. Now, this is a hobby. That's great. It's better than doing a lot of other things. But if you're here at the trading pit because you want to make this a business, these are the things that you have to be asking yourself. I believe these things you have to be asking yourself to give yourself the best chance of succeeding. And when you do succeed, to make the most of this opportunity. And so one thing about the Netto number is, again, it measures return punitive risk. As I just showed from the last slide, it takes the profits divided by the risk factor, and that gets you your number. Now, we can apply this to markets themselves. So there's a lot of transferability with this, with how this works, okay? And then the higher the Netto number, so if you have a Netto number of 2, that's better than a Netto number of 0.5. So the higher the Netto number, that performance suggests that that manager or that strategy or that stock or that future or that currency is doing a better job at maximizing return punitive risk. And the lower the Netto number, the worst. -1 is the worst you can get, because that then implies that you were stopped out and the strategy was then terminated. So -1 is the worst you can get. Whereas, if you're not managing risk, which is kind of the framework of all of this, is that you have a strategy and you're managing risk, then that's where we're at. Like I said, there's 2 inputs in this. There's this unit of risk input, which is risk budget, and then that maximum adverse excursion are what go into the risk factor. Okay. It also is interesting because it serves as a context for profit. So if I were to make, if I have $100,000 account, and in 1 week, or let's say over 3 months, I make $40,000 on $100,000, and I have a Netto number of, let's say, 2. That's really good performance, But it's possible that, in order with that $100,000 account to make 40,000, to have a Netto number of 2, I probably took some drawdown along the way. I might have taken, $20,000 of heat, into the principal before I made that $40,000. That's interesting. So that risk budget also. So let's talk about it. So 2 inputs in the risk factor. One is the unit of risk. That's the risk budget. Second is maximum adverse excursion. Okay. Now, the size of the unit of risk, okay, that size of the risk budget is half of that risk factor. And then the max adverse excursion is the other half of that risk factor. And next slide, I'm going to show you what that looks like, okay? You combine the 2 of those, you divide by 2. You can do this on a napkin, okay? And this number becomes the base to measure against that P&L, that profit and loss. And what that does is it gives you that apples-to-apples comparison you can do. So let's think about this for a second. If I have all of these strategies that are on a risk budget, or they're using the Netto number input system, I can literally take, and this can be adapted for markets, like I said, I can take, all, 7 of the strategies I'm looking at using, okay, and I can say, oh, look, even though this one made more on a percentage basis, this one actually has twice the Netto number. That could be instructive, because then that can, say, well, I would have originally, maybe as I'm looking to become a professional trader, I would have allocated more money to this strategy. However, because the Netto number on this strategy is better, I'm actually going to dial that down a little bit. And that could potentially, signal where things are going, or maybe trouble brewing for a strategy, even though that's a good percentage return, the Netto number is not as high. So that's something that an apples to apples comparison can help us out with. And let's just take a peek at kind of what this, this last bullet point here. So if an investor has a risk budget of $1 million and there was a maximum adverse excursion of $500,000, all right, the metric used to determine the performance would be 750, because we take $1 million, that's the risk budget, plus that 500, we average those 2, okay, and then we divide them by 2, or we take the average of those, however you want to do it. We end up with $750,000. All right, this is what that looks like. As you can see from this formula here, okay, make sure I can use my little laser pointer. Boom. So this unit of risk, like I just talked about, we add that to this max drawdown, that max adverse excursion. I'll use those terms interchangeably. They're not quite the same thing, but I use them interchangeably for the sake of this presentation. Um, but it comes down to this investor budget. So I mean, I would ask people out there, how many of you guys have a budget for your business? How many have a budget for your strategy where you say, okay, beforehand, and then you stick to that budget? That's something that's kind of beyond the scope of this presentation, but all this assumes that you have a risk budget in place. And this comes from my experience, in the futures world, because in the futures world, and in the leverage world, whether you're trading through the trading pit, if you're trading things with leverage, risk management becomes even more important. And one of the phrases I mentioned in the GME is, the better the brakes, the faster you can drive your car. Okay. And so I like gearing strategies. I like playing aggressive when there's real edge, but part of that playing aggressive is I know that I have a really solid braking system. So if I'm wrong, I get stopped out, or I structure trades, especially through a lot of option structures or risk defined structures where, okay, the risk on this trade is defined. I want to risk X to make 3X. And that's a level that, that we want to be at, and go from there. So this is some of the mathematics behind that. Moving on here. Okay, so let's talk about this risk budget, the unit of risk of this risk budget. Okay. When you're sitting down with yourself with an investor, there are a lot of things that look into how you come up with this. Right. So part of it is, what are the historical returns? And this is some of the secret sauce. Let's be honest. This is some of your edge in terms of what you do, is like how you come up with this risk budget lets you know if you're out, trying to raise capital right now, you're trying to convince the people, the trading pit, to give you more money. The better you can articulate your strategy, the better you can explain why this risk budget is the number. It gives you a sense of clarity over what the strategy does. And so if I was going to interview a manager to make an investment, and I was going to have this conversation with him or her, I'd say, all right, what is, what's the risk budget you need? And walk me through why that risk budget is important. Well, for the last 5 years when I've run the strategy, here's what I've seen. Here's what assumptions I'm making when I tell you this risk budget. I'm looking at this amount of volatility for next year. Here are my assumptions in terms of that volatility. I'm looking at these 12 events. I'm looking at the worst drawdown I've had. I'm looking at this possible thing to happen here. And when I take all these things, I see this is a manager or strategy that has thought through what they're doing, and they know what they have. And these are the same things I ask when I'm developing strategies internally as well. So I think if you guys do that, if you can put together a risk budget, you can articulate why that risk budget is the right number. And maybe you add a little bit of cushion to it because things happen, and that's part of the analysis as well. Then you're good to go. Sorry for my cough. I have a little bit of a respiratory infection I'm still working through here. I think a lot of it's going around in the southwest part of the United States here. A lot of people are coughing. At any rate, and the more AUM, so and this is something that is also addresses as well, and that is, there's a lot of asset firms out there that are concerned about getting assets. And so one thing about the risk budget that we have that's really important to note is that the higher the risk budget, as I mentioned a few slides ago, the more that's going to impact the netto number. Okay, and so if you are a manager and you want to be compensated based on the netto number, you're going to think long and hard about what the right risk budget is, because if you can make the same amount of money on a lower risk budget, you're going to get a higher incentive fee. Conversely, if you need a bigger risk budget, you're going to get a lower incentive fee. That's just the way the mathematics of this works, and that makes sense. If I give you a manager a $500,000 risk budget and you think you can make 1.5 million on that, well, then you're going to do really well if compared to a manager that needs a $1.5 million risk budget. It just stands. I mean, that's the mathematics behind this. But the current compensation systems out there, the current methods to evaluate strategies out there, don't look at things this way. They look at things from a standpoint of, okay, well, how much did you make me, and I'll pay you a percentage of that. They don't look at things from a perspective of, well, if you can do less on a lower risk budget, okay, then if you can make more on a lower risk budget than someone else, then you should actually get a higher percentage fee from that to demonstrate that the skill that you have. Yeah. Okay. Now let's talk about the other component. I talked about the risk budget. Now let's talk about the risk around that. Okay, so max adverse excursion is a unique metric for a lot of systems people out there. You're probably familiar with this term. It's known as MAE. It's the antithesis or the opposite of MFE, maximum favorable excursion. And what it does is it measures how much on any given trade you get in that you were down from the opening trade. So let's just say I'm looking at the S&P right now. The S&P is at 4760. Okay, so let's say I buy the S&P at 4760. I buy it, so I'm long. Okay, it goes down to 4750. So it falls down 10 points before it goes up to 4780. So it fell 10 points against me from the entry point, from that principal, and so I was down 10 points. So that trade would have a 10-point MAE, or 10-point maximum adverse excursion. Correspondingly, because it went up to 4780, it would have a 20-point maximum favorable excursion. Now, it's beyond the scope of this presentation, but through implication, you guys can probably understand that you want to develop strategies where the MFE is on balance greater than the MAE. And why is that? Well, there's a number of reasons, but there are things like slippage, there are things like cost. So if you have a strategy where your MFE and MAE are largely comparable, you may be in some trouble because you're making as much as you're losing, at least on balance, and so you're really tight. You're really putting yourself under a lot of pressure to make sure your entries and exits are really, really sharp, or at least your exits have to be really good because the edge is about the same. However, if you have a strategy where your MFE is running 2, 3, 4 to 1 than your MAE, it means that you're typically in a trade, or at least on balance of the strategy, you're up more than you're down. That's a really good sign because, again, your returns may not reflect that, but if your strategy is constantly in a position where it's making you more than it's losing you, there's some real, it may not take too much to tweak that or just keep it as it is. So we incorporate that concept into the risk factor itself and say, okay, we're going to take the risk budget, the unit of risk, that's the first component right here. That's the unit, that risk budget we just talked about. We're going to add it to this max drawdown, or this MAE number here. These terms are interchangeable, all right? And divide that by 2, as I mentioned in this last example from before. So you have a drawdown of 500,000 on a risk budget of $1 million. Divide that by 2, you end up with a risk factor of $750,000, and that's what's used to measure against the money that's made. And so for the purpose of the Netto number, the manager is not punished for drawdown from gain. So what does that mean? So let's say I have $1 million account and I say, hey, Alex, here's $1 million. Alex does a great job. He makes $300,000. Okay. And so he runs that account from 1 million to 1.3 million. If Alex then says, hey, John, I'm pressing my profits here. Okay. And he loses back 200,000, for the sake of the Netto number, it's still 0 on his max adverse excursion because it's measured from $1 million. So I at least when I built the Netto number, I wanted to not punish managers who press profits. Okay. But what I wanted to know was how much was I losing from principal? And so there is some, and this is again beyond the scope of this presentation, there is some path dependence to that. But I did want to reward managers that as they begin to do well, they start pressing. They press. And that's, to me, is a critical skill when it comes to, again, from the outset of this presentation, is how can I risk a little to make a lot? Well, managers who can systematically and proportionally add to size as they're making money is part of that process, and that's what one should do when they have an edge, if they in fact have an edge. Is they should be systematically and incrementally increasing their size as their strategy demonstrates and continues to demonstrate and looks like it will continue to demonstrate further profits. Okay, I talked about max adverse excursion. So let's say an account's of $1 million, has an MAE of 400,000. Going from there. All right, let's try to put this together and come up speed through these. Okay, now, what are some other things that the Netto number does? It solves the problem of backward-looking performance metrics by defining actual risk at play. I talked about this earlier. And then any sort of strategy, if you wanted to, pay yourself, or how you pull out or assess the value, is it works retroactively followed a predetermined time period. So one thing that also is important with the strategy is determining, okay, what's the appropriate time period for this risk budget? All right, so if I say I'm going to give you $1 million and a $200,000 risk budget, is that for next month? Is that for next quarter? Is that for the next 6 months? Is that for all year? And so part of the conversation as well is not just what the size of the risk budget is, but then the temporal component, what the duration of that risk budget should be as well. Okay. And then you talk about hurdles. There's all sorts of ways to tweak this. Again, sort of beyond the scope of the presentation today. But there's a lot of ways to tweak this and the applicability of it, and go from there. And so then now, once again, looking at this formula, we have the profits divided by the risk factor equal the netto number. So in this case here, the profits equal $100,000. The risk budget was $1 million. There's a max drawdown of 500,000. Okay, we divide this million plus 500,000 is going to be equal to 1.5 million. Divide that by 2. There's $750,000. Okay, so you take 100,000. That's the profits so the risk factor is 750. The profits are 100,000. We get 0.133. That's not a very good netto number in this example. Okay, in this example, the person might say, well, look, I made you $100,000. It's like, yeah, but you had a drawdown of $500,000 against that. That's a problem. And so this is a way that you can say, wait a second, this strategy, and then you can compare apples to apples, and there you go. Now let's talk about, we have a little bit of time left today. Let's talk about some of the key events coming up in the market this week. On Friday, we have US PPI, and this meant to say, so that's a typo here. My apologies. I thought I fixed that. On Thursday, we have US CPI. That's going to be an enormous number. We obviously have the Fed in play. There's a lot of question about, especially given the last non-farm payroll number where we had average hourly earnings tick up like they did. The Fed is very much in place. So the CPI number this Thursday, sorry, that's a typo. This Thursday is in play. We also have an enormous grain report. So for those of you that trade crops, corn, soybeans, wheat, it's going to be a huge, huge report on Friday. So we'll be ready for that. And then next Wednesday, looking at the U.S. retail sales, and that's something that we'll be paying attention to as well. All right, future the Trading Pit webinar is coming up. We got 2 left of this incredible series where we're talking to the markets and we're raising awareness for veterans causes. As I mentioned earlier, I'm a Marine. I spent 9 years in the Marine Corps, and we took proceeds from the Global Macro Wedge and we donated them to agencies here, charities here in the United States that place service dogs with military veterans. So if you as you look, if you feel you're getting some out of this is all for free, of course, and couldn't be happier. You can find a charity that supports veterans or charity you like, please, donate and give something and help those who serve us. Okay. But we have 2 webinars left. The next one on the 22nd, I'm going to go really detailed, or at least as much as I can, 36 minutes, and then incorporating economic events into your trading. We just alluded to the CPI. We alluded to the Fed. I'm going to go into a little more detail on that, as much as I can cover in that time. And then the last webinar is something I'm really excited about. This is right out of chapter 19 of the Global Macro Wedge, which is incorporating intuition into your trading. And that's something that I think is immensely powerful, and just intuition is really the byproduct of the analysis performed by our subconscious. So again, our intuition is the byproduct of the analysis performed by our subconscious. And our intuition, and there's empirical studies about what our intuition can process and how channeling that can be a huge skill for you, not just in trading but in life. And so for those of you out there, talk to people who are really successful, they'll talk about how they incorporate and synthesize their life experience and their knowledge into their decision-making process from a place of calm, cool, collective perspective. So really excited about that webinar as well. Like I said, Alex is watching this, and we appreciate him setting this up. I can go into some Q&A now. I covered a lot today. Please, if you need to watch this again, and again, email Alex with any questions. We have his email here. It's in the chat at aaspiotis@thetradingpit.com. Alex will get back to you. Those emails will come to me as well. You can follow me on Twitter at John Netto, at JOHNNETTO. You can ping me on Twitter, ask me some questions there. But I very just incredibly appreciative of everyone being here today. And if you guys have any questions, please fire away, and rock and roll. All right. Looks like there's no questions. Love you guys. All the best to the trading community, and an absolutely wonderful and happy new year to everyone. Happy 2024. And I'll see you guys in 2 weeks. You guys come back in 2 weeks. We're going to rock this thing in 2 weeks, guys. All right. Peace. God bless everyone. Bye.